conversation there. But moving on now, as promised, on the sidelines of the 5th Investec Promoter and Founder Conference, Investec hosted about 70 promoters and founders to understand, what the outlook is for the coming year. To get to know what the key takeaways from the conference are, the pulse in the industry, we're now joined by Mukul Kochhar, Head of Institutional Equities at Investec Capital Services. Mukul, thank you very much for joining in. So in a nutshell, if you had to summarize your key takeaways from the conference, what would it be? What stood out for you? Where was the positive surprise? Where was it that you were negatively surprised?
So broadly, if I just say one thing about, the promoters, is the willingness to invest. We've been doing this conference now for 5 years. This is the 5th year standing. This was also the largest set of people at our conference. For the last 2-3 years, we have noticed that there is a more willingness to invest. Even generally, when you look at promoters, those companies tend to be largely in the mid-cap space. So we're actually sort of noticing a significant propensity to invest for India's growth. Interestingly, some of these guys are also in manufacturing, and they're setting up export units also, and not necessarily, in general areas you expect. Even in things like wires and cables, companies think that there's a genuine competitive advantage that India has in some of these sectors, and their willingness to invest is probably the one thing that stood out. This is also, by the way, backed by our research, and I can even speak briefly about that.
Right. Mukul, I wanted to bring your attention to specific sectors, and I want to start off with auto ancillaries. And you've mentioned in your note that you are confident of a recovery in the premium and executive two-wheeler space. And there is another brokerage note that another brokerage that upgraded certain auto anch stocks today, citing valuation comfort. What's your take on this space? And do you find that same valuation comfort which drives your bullishness on this sector as a whole?
So, one thing to note about two-wheelers, and specifically that was mentioned, is that we are still significantly off peak. At the peak volume was reached in FY19. Today, we are still significantly off peak. So there is room to run as far as volume growth is concerned. More importantly, we think the construct in India, as far as vehicle purchases is concerned, is that the consumer will premiumize, and for the first time in many years, I think 2-3 decades, we will be speaking about a premiumizing customer, or ASP growth. So while in the past the thesis around two-wheelers or four-wheelers was predicated around volume growth, I think this changes somewhat around volume growth and ASP growth. Now, ASP growth is a significant lever for a stock price, much more than volume, because it is pro margin, it is pro free cash flow. It is also pro revenue in a certain manner, because with a 5 to 6% volume growth, you can still post double-digit revenue growth. So the consumer and the sector itself will see a lot of tailwinds over the next few years, we feel. There's and why two-wheelers versus four-wheelers, we think it's a more protected segment. Four-wheelers is a national champion industry for a lot of countries. That's why four-wheeler just gets a little bit of unjustified competition globally. That dynamic doesn't exist in two-wheelers.
Mukul, I want to get back to and circle in on the first point that you made, that you've noticed a significant propensity to invest in India's growth story. Are you also seeing a lot of private capex pick up? Because up until now, capex was driven by the government. It was public sector capex. Private sector capex was lagging. So, this year, compared to the past, is there a pickup in private sector capex? Is there a number? Which are the sectors driving that? And what have you made of the fact that MNC promoters are looking to monetize their holding in India and their holdings in the Indian subsidiaries?
Yeah, good, very good question. In fact, I was hoping you bring this up. See, what's happening with the investment cycle, especially on the private side, is for almost 7-8 years, that is from FY14 to FY21, we did not have any growth in profits, right? So in the private sector. On top of that, because of over-investment, there was over-leverage which need to be cleaned up, right? So 14 to 21, we had an over-leveraged private sector with almost zero growth in profits. So obviously, capex suffered, and there was zero growth in capex as well. Another thing our analysis revealed is that in India, generally, if you take BSE 500, out of 100 rupees in PAT, almost 80 to 100 rupees gets converted into capex. That's 80% to 100% conversion from PAT to capex. What has happened since FY21 is that PAT has just exploded. It has gone up 3 times or 3.5 times for BSE 500. This is creating that cushion. Today, the same capex to PAT ratio is 60% versus typically 100%. This has created a cushion of almost 7 trillion rupees, which is $100 billion extra with the private companies to invest back in the economy. We believe, and by the way, it's already visible. For instance, the same research, and the same data set reveals that in FY23, private capex in BSE 500 was higher than 1.3 trillion rupees. At a base of central government capex, that's almost 13%. That's a lot of numbers, but in a nutshell, there's a lot of cushion now in the private sector to invest, which wasn't there before, because profit has gone up almost 3.5 times. Companies have completely delevered, and in terms of numbers, in FY23, private capex was up by 24% already, which was roughly 1.3 trillion rupees.
Right, and since you spoke of capex, you can't not talk about banks, and there is always this debate ongoing between private and PSU banks. PSU banks have had a stellar run over the last 12 months. Can't say the same about private banks, but the street consensus is that private banks offer more value. What side of the spectrum are you on, Mukul?
So in general, both have some sort of an investment thesis, right? When we speak about private banks, they underperformed last year because of NIM pressure as deposit or cost of funding went up. Their margins suffered in FY23. While FY24, sorry. While the street is still building margin pressure in FY25, we think for multiple reasons that margin pressure will not come and numbers will get upgraded across the private banking space, so which makes it attractive after a year of underperformance. On the PSU bank space, selectively, we are positive based on valuation. Despite we are not oblivious to the massive run they've had so far, but the fact remains that these are roughly 15% ROE entities, some of which are trading around book value, right? So on a fundamental basis, if we can argue that there's no near-term profit cycle or mid-term profit cycle, these stocks should continue to re-rate modestly at a base, ROE of 15%, and then re-rating these stocks selectively should also do well. So the financial sector is looking good overall. I mean, we are positive even on financial savings in the country, and that is why in our model portfolio we have kept the financial sector as overweight.
Thank you, Mukul. Look forward to chatting with you more often. Thank you for joining us today and sharing your thoughts. We'll get into a break. We'll come back.